longtime Fortress investors, new Fortress investors, and all our guests, welcome. My name is Kim Howard, and I'm the Marketing Manager at Fortress Fund Managers. It is my pleasure and great privilege to welcome you to What a Time, recent events and what may be next. Fortress has been operating in Barbados since 1996, offering mutual funds and pension services to many of you on an individual and a company level. There are many of you that have been with us from the very beginning, and we thank you for your continued trust in us. So why are we here? During the past 25 years, we've hosted this event on 9 previous occasions. This is the first time that we've done so exclusively online. Now, time is something that is very important to us as investment managers, because in investing, time is a critical part in making sure you maximize your earning potential. But we couldn't come here this evening without reflecting on this particular time we're living through. I remember the time 2 years ago when we were getting ready to host the 10th annual investment forum at Frank Collymore Hall. Then we were stopped in our tracks when we had to shift our focus completely to make managing your investments from home a seamless reality. What a time it was. Now, at this time, we are hopeful that as pandemic conditions continue to improve, that a safe in-person event can once again be part of what we do. Until then, we're happy to have you here. Now, what do we hope to achieve this evening? Our commitment with this event has always been to share our latest developments, details on our fund's performance, and to give you the opportunity to ask questions about the funds we manage on your behalf, and finance in general. Now, this evening, you'll be hearing from the members of our investment team. First, Roger Cave, followed by Peter Arender, and then Rashada Lopez. After their presentations, our pension director, Renee Delmas, will join me and the investment team to answer your questions. Now, speaking of questions, let me draw your attention to something. Look at the bottom of your screen, and you will find 2 functions when you hover over the toolbar. The one you need to pay attention to is the Q&A tool. That's where we will be reviewing and answering your questions from this evening. We hope that you enjoy the session, and now it's time to hear from Fortress's founder and investment director, Mr. Roger Cave.
Thank you, Kim. Good afternoon, everyone, and welcome to this, our first Fortress Virtual Investment Forum. Hopefully next year we can be together again in person. We miss socializing with all of you all afterwards and Ralph's great food, but we look forward to your questions in the Q&A segment, which, as you know, is the real purpose of our investment forums. What a time is our theme for this evening, and what a time it's been for all of you, the entire world, and for us at Fortress as well, since we last met as a group at Frank Collymore Hall back in March of 2019. While we won't recap all of what's gone on over the last couple of years, we will try in this very short time together to share the key outcomes, mainly from an investment perspective, of what this time has been, and to put some context around that, which will hopefully give us all a better understanding of A, what went on, which really was unprecedented, when in March of 2020, most of the entire world was closed down as governments passed emergency laws, and we became familiar with words like lockdown and curtilage, a word I'd never known at that point, and we were separated from our families and our workplaces. What did we do about it on your behalf while all this was happening? As expected, the result of this enormous uncertainty and the impact on financial markets was swift and dramatic. Thankfully, the response of central banks was equally swift and dramatic. As we say, what a time. We'd like to think, as we emerge from these difficult times, stronger and wiser. And while we don't know what's around the next financial corner, we do hope we gained an enhanced perspective and are better prepared. Peter and Rashada will certainly cover some of this for you this evening. From a Fortress perspective, there have been many changes in our own company. What has not changed, however, is the how we invest. which is exactly the same as it was when we started in this business in 1996. An amazing 25 years ago. Yes, 25 years. I was a young, excited 29-year-old with lots more hair. It was just me alone back then, sitting at a desk in number 24 Broad Street. When the pandemic hit in 2020 and I was alone again at a desk at home, I felt like I'd gone back in time. I can vividly remember launching our first fund, the Fortress Caribbean Growth Fund, on December the 9th, 1996 at $1 per share. Back then we were using a Lotus spreadsheet to track the early investors who joined that year and to value the fund. Today, as we mark 25 years, we have thousands of investors in that fund and assets of over 620 million with a NAV of over 740 a share. Change is constant, and we have been through and continue to be affected by many major world crises along the way. We must always learn from history, and what each of those events taught us was that each time there were certainly better buy-in opportunities. 25 years is a huge achievement, and as we celebrate this milestone in business, we have a number of exciting things planned this year as we give back to the community that has been so good to us over the years. The pandemic has been tumultuous for so many, especially those that have lost loved ones, and our hearts go out to all of you. For us in Barbados, the effect on our economy has been brutal, resulting in job losses, unemployment, and the closing of businesses. For our parent company, Cave Shepherd and Company Limited, our family, our Cave Shepherd retail business, succumbed as well after an incredible 116-year journey. And for us, the Cave Shepherd staff, and all involved in the assets that were lost, this has truly been a heart-wrenching event for all of us. This was our family outside the Broad Street building the last Saturday in January last year, the day the signs came down from the building. As you all know, Cave Shepherd is now much more than just a retail business, and our various financial services companies are all doing very well. Fortunately, from a Fortress perspective, our diversification of our investments locally, regionally, but especially globally meant for us, but most importantly for you as our shareholders, it has been one of the best periods for our company. In fact, 2021 was a record year for Fortress, with all of our funds reaching record highs in terms of their NAVs, and our total assets passed 800 million for the first time. Our growth fund achieved a 26% return for shareholders for the year ending September 30th, 2021. In fact, those who invested in the growth fund in March of 2020, and there were some, are up 55% on that investment in just 2 years. Congrats to you all. As a company, we also made a number of positive changes. We moved our Fortress offices to Radley Court in Cullamorock. We successfully worked remotely when forced to do so under the various lockdowns, and we functioned throughout, taking investments, doing redemptions. All were done online, striking and reporting our NAVs, producing reports, and keeping you, our shareholders, updated. Our Fortress team rose to those challenges in very difficult circumstances, working from home, and we never missed a beat. And to that, I say a special thank you to each and every one of them. You will see a number of new faces who have joined our Fortress team in the areas of customer service, IT, fund administration, and investments, and we wonder how we ever used to function without them. We made some changes too in our product offerings as well, where we discontinued 3 of our mutual funds, the Fortress OAM Overseas Fund, and our 2 income builders in the Cayman Islands. We are pleased that we launched 2 new US dollar funds right here in Barbados in January of last year, and you will hear more about them. We also launched a new pension product called the Fortress Multi-Employer Pension Plan, and you will notice that we have a new website. In the area of compliance and governance, in 2021, First Caribbean decided to discontinue their custody business. and they had been the custodian for Fortress from inception, back when it was Barclays Bank. We're pleased that Signia Globe is now offering custodian services and is now the new custodian for the various Fortress mutual funds. At the board level, we continue the transition of the retirement of our leading founding directors who have looked after and guided your savings, pensions and investments brilliantly for over 20 years. You will recognize these faces, and we could never say enough thanks for all that they have done to bring Fortress to where it is today. These are the new directors that have joined our boards over the last few years, and John Williams takes over as the chair from this year. And we're confident that with the knowledge, expertise, and experience that your investments are in excellent hands as we look to the next 25 years. My time is up. Let's get to the meat of the matter, and we welcome Mr. Peter Aranda, our Chief Investment Officer. Thank you very much.
Thanks, Roger and Kim. We've done this 9 times before in person, and I sincerely hope we can be back together again soon. I never thought I'd say this, but I miss Frank Collymore Hall. I'm going to speak for a few minutes about what has gone on in the recent very eventful times, including the performance of the Fortress funds. Then for the hard work, I will hand over to Rashada Lopez for thoughts on 2022 so far and the outlook. Before that, sorry, I minored in philosophy years ago and I'm still not cured of asking questions like this. Why are we here? Saving and investing is about financial security. This means being able to, on your own terms, afford, and likely keep affording, what's necessary and important to you. In this way, it's central to life. Not the center of life, obviously, but central because it enables so many things that are at the core. How to accomplish this? Earning, spending, and investing all have roles. We need to think deliberately about all 3 because nothing happens on its own. As René Delmas says, hope is not a strategy. When it comes to investing, we think the key word to use is sensibly. To us, this means, first, use assets that have an underlying economic engine and therefore an expected return. Number 2, remember the price trade-off between what you get and what you pay. This is central to investing. And third, remember also in a related way that not all great companies make great investments because sometimes their prices may be too high. Our investment process is objective and consistent. We're just after companies that are profitable, proven, and whose share prices are reasonable. Roger mentioned starting Fortress back in 1996. The Caribbean Growth Fund was the first of what is now a 12-fund lineup in Barbados and US dollars. It's still our flagship fund with over $600 million in assets. Since 1996, $1 has turned into more than $7, but none of this happened in a straight line. Now, many of you listening now will have lived through some or all of these quite natural ups and downs. And under the surface, which doesn't show here, it's not uncommon to see wide variance in the returns of individual holdings. Some have gone up 3, 4, 5 times, and others have vanished entirely. The portfolio averages all these experiences out, which is the point of a portfolio. But we should remember that individual stocks can move around a lot. The business of owning pieces of businesses is really what we're talking about. And here, time helps. Prices tend to be a lot more volatile than underlying fundamentals like earnings. And it's this underlying earnings engine that we're after as business owners. We can all see what happens over the long term, but to get there, you have to live through the short term. There's always a what about? What about? Here's some recent examples. What about Brexit? What about the collapsing euro? What about trade wars? What about Trump? And so on. In each of these cases, there's usually nothing to do as the owners of businesses because the businesses themselves change and adapt. We own shares in Johnson & Johnson in our US equity fund. That company started in 1886 and last year had earnings of $20 billion US dollars. So they might have built up some advantages over the years and know a thing or two about adapting. But the whatabouts come, and that's natural. One way to come to terms with them is to look them squarely in the eye. Now, we just had a great example. What about COVID? So let's go back in time to 2020 when everything stopped. Now, the economic system isn't really meant to stop. Rent and lease payments keep going, as do interest payments on debt. Plus, it's a bit hard to remember now, but there was this huge unknown around the disease itself and a fear that touched everyone. So the financial system, riddled with fear and dysfunction, seized up. As lockdowns spread, companies grasped for financial survival, not knowing what the future would hold. They pulled down credit lines, market makers pulled back, and liquidity evaporated from financial markets. Corporate bonds and stocks fell dramatically. As global markets tumbled, so did our funds. This was one of the worst quarters we've ever had, with the Caribbean Growth Fund dropping 20% in the first quarter of 2020, most of that in the space of just a few weeks. Our global funds in US, international, and emerging markets fell even further in line with the global markets. And even our bond funds declined due to the stress in credit markets. You'll note the three classes of the pension fund declined in line with their various allocations to equities, AA the most and CC the least. Now, 4 windows into this time might give us some good impressions or some important impressions of the conditions then. First, the credit stress was such that BBB rated investment grade bond yields rose by 2 percentage points, an enormous amount in the bond world, and pushed bond prices way down. And that's in theory, if you could actually trade them. Because the bond traders at the big banks had to move from huge connected trading rooms to their homes, and the systems didn't work right away. Plus, the banks were less keen to take risk making markets for clients, as they wondered about their own survival. At the office, we still have a printout from Bloomberg from this time of the bid and ask prices on current US Treasury notes. Normally the most liquid securities in the world, the difference between bid and ask is usually only pennies wide. Here, though, in early 2020, the bid-ask spreads were more than $2, or 2% of the face value of supposedly risk-free bonds. Now, of course, with that kind of stress, stock markets plummeted. If companies couldn't operate, they couldn't earn revenue, and they couldn't pay their obligations. Where would it stop? Would they all go bust? This affected the US, international, emerging, everywhere. Now, quickly, the Fed and other central banks responded. They dropped overnight interest rates to 0 and set about buying bonds, government and corporate, to support the market. They wound up buying trillions of dollars worth, the after effects of which we are dealing with now. Fiscal policy eventually responded too. Governments spent to fill the hole left by lockdowns, and they borrowed heavily to do it. Commodity prices, including oil, dropped. Who needs oil or gas if your cruise ships and planes and cars are all parked? As many of you may remember, oil futures even went negative in late spring. It's hard to imagine today, but the problem with everything stopping is that the world isn't designed for it. There are finite storage facilities to take delivery of physical things, and they were already full. Now, under the surface, company earnings dropped, but then swiftly recovered. The dark blue line here is the earnings on the S&P 500 index of large US stocks. The light blue line is the price level of the index itself. Not surprisingly, over the years, they moved together, similar to the picture we looked at a few minutes ago. Of course, some industries and some places were hit harder than others. One example is tourism. Airlines, cruise ship operators, casinos, and so on did not see anything like the recovery that the broad global economy saw. Now, we here in Barbados know that all too well. So against this backdrop, what did we at Fortress do? First, doing something is not always required. So the first thing we did was nothing. We already had portfolios of great companies trading at reasonable prices. But as prices fell more and signs of panic in the market grew, we took steps to add equity and credit exposure to the funds. Stock prices got attractive, but the Fed responded before the prices could become truly depressed. So we were interested, but not giddy. This was spending cash we had on hand, and we largely added to existing positions. Now, it's hard to imagine now, but at that time, long-term market inflation expectations fell off a cliff. Everyone then was afraid of deflation. As a result, it made sense to own Treasury inflation-linked bonds, also called TIPS, instead of conventional Treasury bonds. So in our bond portfolios, we switched almost entirely out of conventional Treasuries into TIPS. And this wound up contributing significant returns as conditions normalized in later months. In mid-2020, the corporate bond market opened again, and companies almost immediately fell over themselves to issue bonds, even though interest rates on corporates were still high because of the remnants of the panic. To us as investors, it was like Christmas in May. We bought a lot of bonds from high-quality issuers in the seemingly distressed industries whose ability to pay we judged to still be exceptionally high. Issuers like Royal Caribbean at 11.5%, Kohl's Stores at yields of 9%, Southwest Airlines yielding 8%, MGM at 7%. The good old days. They are gone, the rates and the bonds, as we've now sold most once the yields fell back towards 3 to 4% like normal, and the prices rose accordingly. But their effect was a welcome and positive one on our fund's returns. During this time, we also focused on the few things we could influence directly and communicated as much as possible with our clients, you, and focused on daily operations. Thankfully, during this time, our investors generally stayed put, and a heartwarming number took advantage of the drop to add to their investments. That's the way to do it. So what happened next? Well, swift declines were followed by swift rallies for the rest of 2020 as investors wrapped their heads around just how bad the pandemic might be. Our Caribbean Growth Fund was up 20% for the balance of the year, and our global funds in US, international, and emerging equities posted recoveries of 40 to 50%. In the stock market, there were some of the lockdown, work-from-home tech darlings that rallied out of all proportion to their underlying fundamentals. Stocks like Peloton, Zoom, Netflix, Roku, many of which would be familiar to many of you, not the kinds of things we own as investments. A lot of our returns came late in 2020, as Joe Biden won the presidential election, and coincidentally, at precisely the same moment, the data from vaccine trials showed that they worked. Again, it's hard to remember, but that was not a foregone conclusion at the time. This down and then up left the full year returns for our funds mostly green, with a little bit of red in the Caribbean Growth Fund. The best returns in 2020 came from our bond funds, as credit recovered and bonds rallied, and some of our positioning paid off. Our US dollar fixed income fund was up just under 10% for the year. In equities, emerging markets led the way for 2020, up about 5%. Now, 2021 was much more a story of life returning to normal. Many of us got vaccinated and began to travel again. At the same time, the Fed remained hugely supportive, but began late in the year to peel back its pandemic stimulus, which explains why bond returns started to become a little bit negative during the year. You can see that in our bond funds. Investors needed to price in the coming interest rate increases. At the same time, the rally in equities, especially in the US, was broad-based and inclusive. It was not just the technology, it was pretty much everything. Our US equity fund was the strongest of our funds, up 30% for the year. And these returns drove gains in the Caribbean Growth Fund and our new US dollar World Growth Fund. Emerging markets, though, a part of the investing world made up of China, Russia, India, Brazil, South Africa, and so on, barely eked out a positive return. And our emerging market fund did much better than the index, which was actually down in 2021. One subplot through the year was China's regulatory campaign against its own companies. Casinos, video games, e-commerce giants, education companies, property companies, they all came in for tighter regulations, fines, and other forms of pressure that pushed share prices down. This meant much of the good stuff in 2021 was in the US. Now, 2021 was quite a time too, and in some ways it was the speculation that made it remarkable. There's an old saying on Wall Street that when the ducks are quacking, feed them. And the ducks were quacking in 2021 with the easy Fed money. There was the GameStop and AMC short squeeze strangeness near the beginning of the year, but there were also initial public offerings, IPOs. In the US alone, $500 billion in capital raised, more than 1,400 new deals, a record for a single year. The list of 2021 IPOs, or direct new listings, included plant milk gurus Oatley, EV pickup maker Rivian, cryptocurrency exchange Coinbase, online game company Roblox, and hip glasses brand Warby Parker. All are now down 50 to 75% from where they were issued. But at first, they all rallied. The ducks were quacking. The ducks didn't care that all but Coinbase in that list had no earnings and were loss-making. Oatley is a great example of the speculation. Many of us may know their lovely plant-based milk products. Here is what the stuff looks like. Really yummy in your coffee. Here are some numbers, though. The company had revenue of $643 million in 2021, and with this revenue made a loss of $212 million. The company went public in May 2021 at a price of $17 per share, which put the market cap, the value of the whole company, at about $10 billion. By June, the shares had rallied 70% to $29, making the company worth $17 billion. Now, I'm not sure how many of all of us watched the Super Bowl in February, but whether you like watching men in tights or not, you probably know that commercials on that show are entertaining and expensive. The going rate this year was $6.5 million for 30 seconds. Well, Oatley, with its newfound prestige, bought a spot and produced an ad featuring its CEO himself. He's sitting in a lovely field, singing. I'll do a bad job of this, sorry. It's like milk, made for humans. Wow, wow, no cow. After teasing like that, it'd be rude not to show the actual clip. So here we go, 30 seconds at the Super Bowl.
It's like milk, made for humans. It's like milk, but made for humans. Wow, wow, no cow. No, no, no. Wow, wow, no cow. No, no, no. Wow.
No cow, yes, but also no earnings. Today, the share price has fallen to $4.90 from $17 at issue and $29 last June, bringing the market cap down to only $2.5 billion. Most investors have lost money, except the ones who fed the ducks early. I hope the company begins to earn money and succeed. I really like the Barista Edition oat milk, but this is a window into what was not sensible and may still not be sensible yet. Not proven, not profitable, high price. These obviously aren't the games we play, so in 2020, we lagged the crazy stuff, and in 2021, held our own quite well with our diversified portfolio of high-quality businesses. So the main drivers of returns for the Fortress funds in 2020 and much of 2021 were our core global investments. Within the Caribbean Growth Fund, we also had some individual investments that are worth noting. The first is Berkshire Hathaway, which is the holding company overseen by Warren Buffett, needs no introduction. When we purchased our position in early 2021, it was still overlooked and hadn't kept up with the rest of the US market. Since then, boring is sexy again, thank goodness, and the stock is up 50% from where we added it. The fact that the company has been spending its cash pile to buy back shares has also helped. Large cap US biotechnology shares also added to returns in the growth fund. This is a sector that has been reasonably valued relative to its fundamentals for some time. The pandemic helped revive interest in the area, and there were substantial returns on some holdings through much of this time. Our investment is partly via an exchange-traded fund for diversification, and at various times we held and made some outsized gains on individual names such as Amgen, Moderna, and Regeneron. I'm also pleased to report that even though equity markets in the Caribbean overall did very little, some of our holdings close to home did quite well. The oil boom in Guyana has lit a fire under some of the listed shares there. Our long-term holding in Bank's DIH more than doubled, and there were gains as well in Demerara Bank and Demerara Distillers. In Trinidad, Guardian and Massey, both proven, profitable, and reasonably valued businesses, have generated large gains recently. Their earnings have been good, even during the pandemic. In addition to the businesses we're all aware of, Massey also has a growing presence in Guyana. Now, not all things went well for us. We made plenty of mistakes all along the way, and no doubt we'll make more in the future. There were also some natural headwinds to performance in 2020 and 2021. Rising inflation in late 2021 brought upward pressure on bond yields and corresponding downward pressure on bond prices. Our bond fund returns reflect this. Our value-oriented global portfolios lagged during the tech-centered rally of 2020, but they held their own in 2021, even around all the speculative activity and the quacking ducks. We also favor globally diversified portfolios as opposed to investing in just one area such as the US. We believe this opens up a broader set of opportunities and reduces overall risk. At times where the US, or any one area for that matter, outperforms the others, this broad diversification can mean we, and maybe you, look back and wish we had more of the thing that was up a lot. Such is life. Now that's it for my update on some of our recent eventful times. There will always be more what-abouts in the future. But long-term investing, thankfully, does not require that we take them on or even try to solve them. Thank you, and I'll look forward to your questions later, the main reason that we're here tonight. For now, I'd like to introduce the newest member of our team, investment analyst Rashada Lopez. Rashada joined Fortress in early 2021, and she works with us on all the Fortress portfolios. Rashada is also a regular contributor to our weekly audio update, Just a Minute with Fortress, so some of you may already recognize her voice. She'll pick up the What a Time story from here.
While this is Peter's 10th forum, this is my first, and I'm very much looking forward to transitioning to an in-person forum in the very near future. I'm going to cover our 2022 year-to-date performance, key themes that we see coming out this year, and also what we see going forward. So, welcome to 2022. There's a saying that after one time comes another, and we're definitely seeing that this quarter. Global equity indices have come under significant pressure since the beginning of the year. The MSCI World Total Return Index, which tracks the performance of global equities, went down about 11% year to date, and this performance is quite similar to the more familiar S&P 500 index. When you take into consideration the high valuations we were seeing coming out of 2021 and moving into 2022 with the headwinds that Peter touched on, this kind of performance is not surprising, as some of the air gets forced out of the higher prices. One key theme we're navigating this year is the onset of higher interest rates. During 2021, we experienced record high inflation, and this year, in February, the Consumer Price Index came in at 8%. This came from a combination of pent-up demand and some supply-side factors. What we face now is grappling with the US Federal Reserve's monetary policy response as we move further into normalization territory. The Fed has a delicate balance to strike between hiking too aggressively and stalling economic growth and hiking too slowly and not addressing inflation. While higher rates send current bond prices down, it presents the possibility of acquiring new bonds at higher rates. Here, we have positioned our bond portfolios to be flexible to respond to changes in interest rates. Another theme so far for this year is value stocks outpacing growth. Quality continues to hold well, while growthier tech stocks are coming under significant pressure. You can expect this in a riskier type of environment as investors take a risk-off approach and switch into value-type stocks. Higher interest rate environments further support this rotation. This has worked in our favor because the type of equities that we own fall largely into this category. For example, the index that tracks the Dow is down 9% year to date, while the NASDAQ index, which has a higher weighting in tech stocks, is down almost 20% year to date. However, this has not always been the case, and over the past decade, the Russell 1000 Growth Index has returned 17% annually, while the Russell 1000 Value Index has returned just 10%. The Russell Growth Index is down 19% now, year to date, while the Russell Value Index is down only 6%, as value continues to outperform growth. More recently, the Russia-Ukraine conflict has directly and indirectly impacted global investments. The direct effect was felt in our emerging markets fund, which held Russian stocks. Up until February, the fund was up 5%. Subsequent to the invasion, the fund is now down 9% year to date. The immediate effect of the invasion has otherwise given us the opportunity to add on weakness in our international holdings. Beyond that, there has been no substantial immediate effects. While bond investors are pricing in the possibility of a resolution to the conflict, as seen in higher yields, there are some longer-term implications that could change the investment landscape. First is the idea of investing in emerging markets and the possibility of geopolitics playing an even bigger role in determining how risky these investments really are. Second is the path of interest rates. The sanctions placed on Russia, being one of the biggest suppliers of oil and other commodities such as fertilizers, has the possibility of shooting inflation even higher and slowing growth. The Fed's plan for monetary policy adjustment will now have to take this into consideration. And third, the idea of the peace dividend in reverse. After World War II and the Cold War, many governments were able to reduce their defense budgets and allocate more to social spending. The invasion of Ukraine has the possibility of making governments think about how peace might be unpredictable and how to prepare for external aggression, which may lead to higher taxes to fund this. Given those themes, our Fortress funds are down year to date, with the broad pressure being felt in the Emerging Markets Fund. The Caribbean Growth Fund, however, due to its diversification, has been able to hold its own relative to our geographically concentrated global funds. The Caribbean Growth Fund's allocation is now 70% global and 30% regional. We have benefited from the diversification of our holdings once again, as our holdings in Guyana and Trinidad have buffered some of the performance in our global funds, namely Massey, Banks DAH, and Demerara Bank. This brings us to our outlook for the remainder of the year. It's always useful to keep in mind that there's always going to be a what about. What about COVID was one we can use to inoculate ourselves against the most recent what about, which is what about Russia. As we have seen, the markets over time bounce back from these short-term volatilities, and the best way to ensure steady capital accumulation is through owning high-quality businesses at reasonable prices, which are exactly the type of securities that we own. Our global funds are positioned to perform well over the medium term, given the quality of holdings and their valuations. This is because the equities in our global funds trade below benchmark PE levels and are cash flow generating and have return on equities in excess of the benchmark. For example, our US equity fund has a price to earnings ratio of 14 times when compared to the benchmark of 21 times. This fund also has a dividend yield of 2% and is cash flow generating with a price to free cash flow of 13. The international and EM funds also share these similar characteristics. These factors help to justify an outlook of high single-digit returns over the next few years. On the bond side, given interest rate environments that we see, we expect U.S. bonds to generate returns in the 2 to 3% range. And finally, in the Caribbean, we still see a few pockets of opportunity. The Guyana situation is one to continue watching, and as tourism rebounds in the near future, we hope to see a recovery in performance in Barbados and Jamaica. I hope that you've enjoyed our presentations. Now it's time for Q&A. I hand you over to our marketing manager, Kim Howard.
I just want to let everybody know we're joined here this evening by René Delmas, who is our pension director. He was not speaking, he didn't speak this evening, but he's here to answer questions about pensions and all those wonderful things that he enjoys. We also have Roger Cave, our investment director and founder. And to my left, we have Peter Arender and Rashada Lopez on the end. Now, you are definitely watching time because evidently we're still having a time, as evidenced by that glitch that we had earlier. But hopefully we're all past that now, and thank you for sticking with us. I'm going to allow the panelists if there's any particular pressing things that you all want to start with, or should we just jump straight into the questions?
Yeah, if you've got any questions lined up, let's go.
René is late. Let me go. We're ready to go. All right, so we have quite a few questions here, and some of them have to do specifically with people's investments, and then some of them are sort of more general questions. So thank you guys for sending your questions through the Q&A portal. So one of the first questions here is, any plans for a regional renewable energy fund? A regional renewable energy fund? Peter, you want to take that? I see Roger looking at you.
Sure. Well, it sounds like there's already one around. But good evening, everybody. And I promise I'll only answer this question once, and you won't have to hear my corny jokes more than once either. I think, as Roger can probably elaborate on, renewables are something we've been looking at for years. And I know, not to speak for Roger, but it's something that he and we believe in very strongly and as a thing in society. We're open for business for looking at things within our funds or whatever. But I think that the important thing when looking at renewables or anything in any category that happens to be impacting our lives at any moment, and that certainly is in that category, is to come back to some of that boring stuff I mentioned before about what's the price, what's the cash flow you're getting, what's the life of the investments, and what are the risks? And so those are just the things that we look at in all ways about all things renewable and otherwise.
And we have another question about starting funds. I think maybe Roger might want to look at this one. Will you be launching a fund to support local development efforts, tourism and agricultural, in the aftermath of COVID? No, don't start small at all.
Thanks, Kim. And what I would say is that's a great question. We just launched 2 new funds last year, so we don't have any immediate plans for a new fund, whether it be renewable energy or any of the other things that we might look at. But we certainly are always on the lookout to give, to investors opportunities in new things, and so we will be looking, but we don't have any immediate plans for any new funds.
Okay. Now, I have a question here about investing with, and they're referring to investing with $100. So presumably they're speaking about our Caribbean Growth Fund, which you can start investing with as little as $100. It doesn't mean you have to start with 100, but as little as $100 to start. So what does your offer of joining for $100 mean for me as a first-time investor? And how can I grow that $100? Can I put in more every month?
Yes, maybe I can take that one. Mm-hmm. So, and we started, as I said, 25 years ago, and it was $100 to open an account then. And the great thing about the funds that we have, they're valued every week, and you can add new investments any week, or you can redeem off of them. So it's very flexible, and what we also have is a monthly direct debit savings plan, which we highly recommend. So if you're starting small, that you contribute to build the account up to a size, a meaningful size, but it's very flexible.
Now, speaking about flexibility, I have a question for you, Renee. I have someone asking, can they transfer the funds from their Caribbean Growth Fund? So we had somebody talking about getting into the Growth Fund. Somebody now wants to find out about transferring from the Caribbean Growth Fund to their pension fund. Is that something that somebody can do?
Well, at the moment, Kim, the law doesn't permit that. You can go from obviously a group pension plan or individual pension plan to another RSP, but I wouldn't certainly advocate going from a mutual fund, the growth fund, into a RSP because of the tax changes that have happened recently, where you no longer have tax allowances on your RSP. And then if you withdraw it from your RSP, you then have to pay tax. So I certainly wouldn't advocate that. I would just suggest you continue adding to your mutual fund every month and continue to build it that way.
Okay, sounds like good advice. We have a question here that I know that that Roger probably would like to answer, and it has to do with the new mutual funds that we launched. Somebody wants us to elaborate on the 2 new mutual funds that we launched last year.
Okay, so there are 2 new US dollar funds, and they're domiciled here in Barbados. The minimum to open an account is $1,000 US, and you can add to it for $100 US a month. The funds are valued every Friday, just like our growth fund and our high interest fund, and they're almost very similar to operate to our 2 Barbados dollar funds. The good thing is that it offers immediate exposure. One of them is a growth fund to equity markets in the US, international and emerging. And it's a fixed income fund that offers exposure to world bond markets.
Now, you said exposure, and that reminded me of something that I had meant to say at the beginning, but did not remember. Each of us spoke about the fact that we really would like to be back in person doing this. And we recognize that we still are not 100% there yet. So we took the additional precaution today of everyone having a COVID test before we came here today, before we sat down here comfortably with our wonderfully masked faces talking to each other. So I just wanted to make sure everybody was aware of that. But Roger, you mentioned that it's pretty easy to get into those new world funds, but you said $1,000 US to start. Can I just take the $1,000 US I had onto my mattress secretly and bring that in?
Well, technically no, because it comes from a bank account. Okay. So it's not, no one should have money under their...
We don't advise.
Yes, we don't. We know it can happen, but no, it's transferred from your local commercial banks.
Right. Yeah. Okay.
As you know, that the laws changed to allow Barbadians to have US dollar accounts in our local commercial banks.
Okay. All right. Well, thank you. So if you are interested in the US dollar funds, you also have to have a US dollar account, which is something that is now available in Barbados after some recent changes legally a couple of years ago. Now, Rashad, I have a question here. Someone's asking for advice. So I figure since you're a young professional, they're asking for advice from the perspective of a young professional. Okay. So any advice for a very young professional who's interested in investing their salary? I hope that they're not investing their whole salary, but yeah.
Well, yes, for starters, let's start with not investing your whole salary. I would definitely advise going into the process with a budget, looking at your expenses and tailoring that to something that is livable. And as Peter always says, to pay yourself first. So if you have a certain salary, you stick to your budget, you allocate savings out of that, and then you can go from there into building what you might consider a safety net. So looking at keeping savings that would cover you in the event of any emergencies. And then after that, looking to invest from there. So after you have your safety net, looking to start an account with a mutual fund to start investing. And that is what I would advise.
Okay.
And I would just add, if I could, what a great question. Somebody who's just starting out. I mean, Renee, you could say, how many times do you have people who are like our age, like in their 50s, coming to you and saying, Renee, I'd like to make the following announcement. I'm ready to start saving for my retirement now. What should I do? So yeah, so starting young is absolutely the way to go.
Yep, I would say so too. And you know, even if you haven't started, you know, somebody who's fresh out the block, you're now working and you haven't started, you're not able to start. You may have commitments. People think that, you know, somebody who's now starting, they have no commitments, but it's entirely possible that you can start working and be young and have commitments that may restrict what you have as disposable income. But just remember that it is not necessarily always a lofty amount that you need to look for. And as we mentioned earlier, the growth fund allows you to start with as little as $100. And you can build on that as time goes by. So there was another question here I saw just a little while ago. Someone asked about RRSPs. Now, for those that are listening, RRSP is a type of personal pension plan, and we offer that as well. But a couple of years ago, there were some changes that were made that, well, we took a different position on them. So I have two questions on RRSPs. One is, I have RRSP with Fortress. Does it make sense to move the funds from there to a mutual fund? They're not sure which one, but they're just wondering if it makes sense. And then the other question is Fortress still taking funds in the RRSPs? And are we lobbying government to bring back the tax incentives for RRSPs or to remove the tax on withdrawal? So first question, does it make sense to move your RRSPs to a mutual fund?
Well, sort of no, because once you take it out of a mutual fund, you will attract a 25% tax.
Okay. And you say take it out of the RRSP.
Take it out of the RRSP,
Yeah.
yes. You will attract a 25% tax.
So when you say, so hold on, just slow down right there. Once you take it out, it
redeem.
takes it out at any point at
any
all?
point, yes.
So even if I'm retired or, well, no, if you're retired, it doesn't matter.
Well, if you're now we're going into another question.
Sorry,
let's get to two questions and then we come back.
Anticipating some of the things that people
So I'm talking about redeeming from the mutual fund prior to retirement.
the RRSP.
The RSP. Thank you. You remove the funds, you'll attract a 25% tax. So if money is already in there, keep it in there till retirement. But if you want to save, well, like you've just heard Rashada say, open a mutual fund account, put the money in there. There are no tax implications, there are no expenses, no fees. And in the event of an emergency, you can have access to it. And once you take it out of a mutual fund, there's no tax. So if you have a RSP with funds in it, I would advise you just leave it there to retirement, which is age 55 and onwards, and you can withdraw. The law allows you to withdraw 25% tax-free, and then take the 75% in the form of a pension. That is still going to be treated as taxable income, but at least you wouldn't have to pay the whole 25% by taking it all out. Now, I'm sure there was a third question along.
Yeah,
Double tax.
Double tax.
double tax.
And why?
Well, are we
yeah.
lobbying? Are we lobbying to have that removed?
Yes, and in the past we had for that tax allowance that government had that allowed people to save for their retirement, and you got a tax deduction when you did your income tax. That was removed a couple of years ago, but what was not removed was, as I mentioned before, the tax at the back end. So if you fund your RSP, you're funding it with after-tax dollars, and then if you redeem or get in the form of a pension at the end, you pay tax on it again, double taxation. So that's why we would not advise anybody to add currently under the current tax regime to your RSP. As far as lobbying government, we have written many letters. We say this at every forum that we have. And there's not much more that we can do but to continue to advocate for the removal of this double taxation regime. It just doesn't help the situation very much.
Yeah, I could add to that to say that it really is a tragedy. The tax incentive was changed in 2015, and back then we advised our clients not to add money to their RRSP. because it's actually, they're worse off from a tax point of view. You cannot so it's 7 years now that incentive, you know, has been removed, and very few people contribute anymore to their RRSPs. So it's a great pity, and you cannot regain the 7 years that have been lost. And we do hope that it will be looked at and it will be changed. And as Rene said, we have written, and we would like to see it change.
But we still encourage people to continue saving for retirement. It's
Absolutely.
just not through that particular vehicle.
Not through that vehicle,
Yeah.
because they're worse off than if they save directly.
Right. Okay.
And you get the same returns, if I can add, Kim, the same returns by, you know, the RSP is just an investment wrapper. The same returns you get in a mutual fund, you'll get in the RSP, but then you don't get the tax issues that we just spoke of
Right.
when you invest in a mutual fund.
So investing in a Fortress RSP would have allowed you to have a wrapper around some of the Fortress mutual funds, is what you're saying?
And you would have gotten the tax allowance
Right,
in the
right.
good old days.
Yes.
Now that's removed, just put your money in a mutual fund.
In one of the same Fortress mutual
Yes.
funds. Understood. Peter, you had something to add there, or no?
No. I think I mean, we talked about tax incentives, and the only thing I'd add is that really, it's not that the tax incentive went away. It's more that there's now a tax disincentive, and I think those of us in Barbados who would like to see this change is not a clamoring for a new tax incentive. It's a clamoring to remove a tax disincentive that is quite easily fixable. That's all.
Okay. Now I have an interesting question here. There's a question about what are some of the best information sources you can consult to learn about stocks in our mutual funds, in Fortress's mutual funds? I don't know who wants to hit that one.
That's a tricky question.
I know. I mean,
Do
you
they
can.
get easier, Kim? I don't know.
I know you can definitely start with our quarterly reports, where we do list some of the major holdings in our various mutual funds in all of the quarterly reports. You can find that there.
And our annual reports as well, and all of them going back are on our website.
Right.
Yeah.
But in terms of if somebody who wants to take the time to investigate some of the holdings.
Well, if I could take a stab at that.
Yeah.
I mean, I think of internal resources within Fortress for those that might be useful, or people who are curious about those things. As Roger mentioned, on our website, the history is there. You can read it, maybe learn from it, maybe you got a good chuckle at it, whichever, but the annual reports the history is there. And the quarterly reports come out regularly. They have some content as well. And every week, or most weeks, there's a just-a-minute update that we offer as well that comes through our social media. In terms of general reading, I mean, what we do in mutual funds is pretty straightforward. So any reading that anybody does about mutual funds generally, about finance generally, I would say is almost all applicable to what we do. Right? If you read something about mutual funds, that's what we do. That's it, got it, done. So. And anything in that category is great. And we always say that, you know, it's funny about financial awareness and so on. I mean, dealing in our funds is easy for our clients. But it's best if everybody understands at least something about what's going on, because as we were talking about earlier, there are always ups and downs. And when we can all understand the project better and feel part of it better and understand what's going on under the hood a little bit, it just helps us all stay the course. So having clients who understand and are engaged in it really would be our dream. Like that's the best way.
Yeah. I always like to think that a well-informed investor is the best kind of investor to have. We have a question here, and I've seen a couple of them about cryptocurrencies, and I think we get this almost every time we make an appearance. So, will Fortress Growth Fund invest in cryptocurrencies, blockchain, fintech type opportunities? Tell me, investment team.
Want to try that?
Yeah, sure. So I guess I would start out by saying, just giving a brief example or a brief explanation of the type of securities that we look to invest in, which are value securities. We covered it in our presentation. And what we really mean by a value stock or value equities, you can think of it as a company whose earnings really depend on the business model and the operations of the company right now, rather than the optionality of the earnings in the future. So under that definition, we really don't see cryptocurrencies and these kind of growthier tech-style securities falling into that category. And I'm not sure if, Peter, you want to add something else to.
Yeah, I mean, Roger's right. We get the question a lot, and it's definitely under the category of, hey, how come you didn't back when Bitcoin was $2,000? And okay, the general underpinnings that Rashada just mentioned, I think, are exactly what we're after. So, the minute we can be presented with a good, liquid, profitable, proven company at a reasonable price that deals in any of those categories, we're up for it. Haven't really seen a lot of them yet because other investors through this time have been so keen to put a high price on what may be in the future, and we haven't seen yet of things that are currently earning. I mean, one example, we looked, I think we mentioned earlier, the stock Coinbase, which went public last year, and those who trade crypto would be familiar with. I mean, they do make money, but when we look at that, our take on it is big profit margins that are likely to get squeezed as other companies come in and offer the same services. So it's not for lack of looking, it's for lack of finding. And the minute we find, we're happy. We're the first people to take the names off things and look at what the earnings are and what the price is.
So I have a question around the Fed and interest rates. So the question is basically to make it simpler. Can the discussion around the Fed and interest rates be simplified to understand the relationship to how it affects the economy? I presume they mean the Barbadian economy, because the Fed is the Federal Reserve, the US Federal Reserve, which is essentially the US central bank. So how can we discuss a little bit, Peter, how simplify that, how the Fed and the interest rates can affect the economy?
Sure. As a central bank of the United States, the Fed has a very special role. Partly it's about the United States, but partly it's about the world, because the US dollar, some people would like it not to be the case, but I think it is still the case. The US dollar is the primary reserve currency through which a lot of other commerce globally is transmitted. So when the Fed is cutting interest rates, all things being equal, it helps financial assets be worth more and helps the economy grow. And then all things being equal, when they're raising interest rates or too high interest rates, it tends to put a damper on the economy and will tend to be a downward pressure on financial assets like stocks. That's all things being equal. Nothing's ever equal, right? So we never know what equal is because things are always changing and people all have expectations about different things. So what we're finding now is the Fed is starting to tighten a little bit. And the question is, oh no, sell everything, the Fed's tightening. But they're tightening from zero. So from 0 to 25 basis points or 0.25% is nothing to worry about yet. Now, the balancing act the Fed is dealing with, I think as Rashada alluded to earlier, it's that you've got recent inflation readings are high, and the question is how do you respond to that without tapping the brake too hard on an economy that may already be slowing. So that's the balancing act that the Fed is dealing with now, which probably explains why they haven't hiked more at this point.
Okay.
So the market is expecting the Fed to hike 6 or 7 times this year.
Yeah.
Do you believe that the market is right on that? Would you expect that?
What's the over/under? So we're back to the Super Bowl again. Well, I mean, I guess maybe we put the actions first. We've been buying 3 to 5 year Treasury bonds and corporate bonds in the last few weeks as interest rates have risen, and that's on the based on our judgment that it'll be difficult for the rates to rise faster than that, and it's quite possible that the rate increases will come slower. So I think on balance, if you got to call the over/under, I think we'd call the under on it and suspect that while they do need to hike, hiking has to happen. Probably the market has priced in a little more hiking than is likely to happen.
All right, I'm seeing a question here that I've seen it a couple of times via our social media and elsewhere. So I'm going to ask it here so we can say it publicly. Why can't the sign-up process be done online from start to finish? I have brokerage accounts overseas. If I had to travel to open each one of them, that would be inconvenient. So why can't that process be done online from start to finish?
Don't get Roger started. Kim.
I want people to know that people want to know. Tell the people.
Yeah, I would say that we would wish it could be so, and we are working towards getting there. We're not there yet. Part of it is regulatory, and so hopefully what we did see through the pandemic, there's a lot more things could happen online, which they did, but I think our regulations do still require an actual application form and wetting, and we still don't accept electronic signatures and those things from a regulatory point of view. So, but we're going to be there, and hopefully there soon. So.
And the important thing to just reinforce there as well is that I don't think people always appreciate that that we're governed by regulations, that we have to answer to a regulatory board. That would be the Financial Services Commission.
Yeah.
So it is not a case of these are random rules that we decided to create and try to make life difficult or inconvenient for you. We're trying to follow the law so that we can continue to be open and to continue invest and to make money for you. But it is not something that we can just decide that we're going to float unless we're not interested in remaining open. And I don't think that anybody wants that.
And I think during the COVID time, to Roger's point about it being a bit of a silver lining, I mean, how many checks do we issue now each week in redemptions? We used to, whoever wanted to redeem each week, we'd write checks. We'd have people bringing checks for us to deposit, and now everything happens online. So as Roger said, it's not where we want it yet, and we're working to make it how it should be. We agree 100% with the question, but it's nice to see that at least one of the silver linings coming out of that all the time that we'd had in COVID was pretty much everything is electronic now. On terms of payments back and forth.
So I have a question to do, not surprisingly, to do with the current war taking place in Europe. And the question is, do you think it's likely that when the war ends funds, we'll see an increase like we did, funds will see an increase like we did with COVID? No, we don't make predictions, but I don't know if you could share your thoughts.
I don't know, what do you want to try it?
Markets always tend to overreact to bad news. So as we see with the COVID situation, markets really went down following that. Similar to the Russia-Ukraine invasion, we also saw markets all over the world, whether that's US, international, emerging markets. They all went down on that news. So coming out from that, we saw a bounce back in the performance in not only the international and the emerging markets, but also in the US. So as Kim alluded to, we're not in the business of making these very sound predictions or saying it will bounce back by this amount or there will be a return of this amount, but we definitely have seen a recovery in our holdings.
Thank you, Rashada. And yeah, like as Rashada and Peter talked about in their presentations, there's always a what if and what about. Yeah. So there will always be something. The important thing is to stay the course, and that is sort of the very model of investing in mutual funds, is that we don't try to get distracted by what will happen, because there's always going to be something happening. So we have another question I would like for Renee to answer, and somebody asked. They said they have a small business and they wanted to know a little bit more about this multi-employer pension plan that Roger mentioned earlier in his presentation. So can you tell us a little bit about that?
A novel approach to pensions other than the traditional way, where previously sponsors, i.e. employers, would take out a pension plan for their employees. All the rules and everything would be related to that one employer, and employees of the company would then join. They, of course, then had all the expenses and effort to run this pension plan, because it's a legal entity. There would be trustees, got a lot of regulatory reporting to do, etc. The legislation now allows for a multi-employer plan, which in essence is one plan that several unrelated employers can join. Which then means there's only one set of filing, one set of regulatory reporting to do, etc. But the key thing, how we have structured it, is that we have appointed trustees that will take care of all the work. So for just one, small administration fee, the employer can get on with running his or her business. Do what you do best and leave the running of a pension plan to the trustees and Fortress. So it just takes the effort and the frustration of running a pension plan away from the owners of the business and let them concentrate on what they do best and hand it over to Fortress to take care of.
Okay.
Yeah.
Thank you. And it's definitely, like you said, it is a bit of a novel thing. So, if you want to find out more information about it, there is information on our website, fortressfund.com. But also Renee is available to talk if you need to have some more details on that. Now we have more questions than we can finish answering here in this session. We only have a few minutes left. But what I will say to you is that we always make sure to answer as many of those questions as possible. So once if your questions are sent anonymously, I'm not sure if we're able to email you because we don't necessarily know who it is. But anyone else, if you have sent your questions in and we don't finish them here, just know that we will reach out to you after today to respond as best as possible. I think we can close with one more question, and there's so many. I think we opened quite a can of worms with the RSPs, and that's always one that people want to know more about.
There was just a budget in Barbados. Does anyone?
Oh yeah, I saw something
have
about
any
that here,
thoughts?
and I was trying to find it again, but
Any questions about that?
questions have been coming in fast and furiously. So I think I lost sight of that one. Okay, so do you think the tie to the US dollar will change with the emergence of China as an economic superpower, especially in light of the conflict in Ukraine, and their offering of alternative payment methods for people wishing to come to business with Russia? So we have the Russia question.
Ooh.
Yeah, that's a very
That sounds like a messy one.
Yeah.
I'm not sure which is more fraught, that one or the Barbados budget question. Maybe I'll take the China question. It sounds like it's kind of a packaged up question of the Russia-China alliance. One of the things that has been a thorn in their side has been the long-term hegemony of the U.S. dollar, and I would suspect that that the U.S. dollar still is and will remain the main reserve currency. The yuan is a long way off from being a reserve currency. Having said that, the kinds of concerns that we have at the moment as it relates to China open up one of the relatively few very interesting investment opportunities in the world at the moment, and that is that big, well-earning Chinese companies, especially those listed in Hong Kong right now, are trading at fantastic valuations. And as Renee will tell you, that there's never a time to invest in things when it feels good. Isn't it too risky to invest? And you certainly wouldn't want a whole lot of your portfolio, as we say, in emerging or necessarily in there. But if you look around in the context of a really diversified portfolio, the kind of stuff that's going on there is really interesting. The Fed is tightening now, the tightening cycle. China just announced last week they're easing. So it's hard to imagine this hasn't been coordinated. Jake Sullivan's meeting over. Anyway, I suspect that there's been some natural passing of the baton, and that you've probably got a time here now that the regulatory pressure on the Chinese companies has been announced. It's over. China is easing monetary policy as the Fed is tightening. I wouldn't be surprised to see big gains in Chinese shares, but not because they're going to overtake the U.S. dollar, but just because of all the bad news that's out there right now.
And there's always bad news.
There's always some news, good and bad.
Always good and bad news.
One guarantee.
And yeah, just a quick addition to that. Somebody asked earlier if we'd be getting into the Asian market. We are in the Asian market. We're pretty much everywhere, yes? Is there anywhere that we're not?
We're like Chicken Man, we're everywhere. Yep. Yep.
So, yeah, we're like Chicken Man. That's what we're going out on. But yeah, we're in the Asian market, we're in Europe, we're in everywhere. If you have a look at our website, look at some of our annual reports, quarterly reports, we do speak about where we're invested. And so there's information there. We have taken up quite a bit of your time this evening, and we really appreciate you joining us. As I mentioned earlier, many of your questions are still here to be answered. Some of them are similar in nature, but we will get back to you. So please listen out for us. Once your question had a name attached to it, we'll be able to email you and follow up with your questions. Thank you again for joining us for the Fortress Virtual Investment Forum, and we look forward to being able to see you in real life next year. Thank you, everybody.
Thank you.
Good night.
Right.